I've noticed a lot of people aren't familiar with the Multi-Year Guaranteed Annuity, or MYGA. So in today's video, I'm going to break down exactly what that is and where you can use it in your retirement. A multi-year guarantee annuity is an annuity that has a fixed rate for a period of time. Now, they're very similar to a CD at the bank. It's not through a bank, it's through an insurance company. But where people are really familiar with this product already is understanding how a certificate of deposit works. A certificate of deposit is something you sign up for at the bank where you commit to a term and they give you a fixed rate that the bank will guarantee. Now that's how a CD works. A fixed annuity, or MYGA, multi-year guaranteed annuity, is something that's very similar, but there's some very big differences. Number one, banks have FDIC insurance, insurance companies do not. So that's a really big differential right there. Another big differential is that the interest on MYGAs, or multi-year guaranteed annuities, is tax deferred. And that's very helpful, and I'll get to that in a little bit later. Now, a CD, you get a 1099 for the interest every single year. But a multi-year guaranteed annuity gives you the ability to control when you want to pay tax on your interest. So you can compound that money in the annuity until the term is up. Now, right now, it's really popular to get short-term CDs at the bank, 6 month, 7 month, 11 month. And some people are looking at that going, hey, I got a great rate, I'm excited, I get to lock that up. But where there's a little bit of concern is what happens with the future of interest rates. And having the experience of working through the last decade of low interest rates, getting to see the power of locking in some of these higher rates for a longer period of time could be really useful. So when we're looking at the multi-year guaranteed annuity, typically you're going to pick a term anywhere from 1 to 10 years. And so when you go with the shorter term, generally you're going to get a little bit lower rate, and then you're going to get a higher rate for the longer term you select. So for example, the 1-year rate may be around 5%, and then the 2-year rate may be around 5.4%, and then the 3-year rate may be around 5.7, and so on and so forth. So the longer term you're willing to commit to, the higher the rate you're going to be able to get. Now, another big difference between a fixed annuity or multi-year guaranteed annuity and a CD is that generally the penalties on fixed annuities or MYGAs, multi-year guaranteed annuities, those are all synonymous for pretty much the same thing, the same type of annuity. It's a fixed rate for a period of time that you're committing to. Those penalties are generally going to be tremendously higher than a CD. So if liquidity is the biggest priority, a CD may be more appropriate in some cases, or at least for a good portion of your money. But if you're looking for a fixed rate that you want to lock up and make sure you can get that fixed rate interest for a longer period of time, that's where the multi-year guaranteed annuity really helps people. So let me give you a couple examples where people are using this in their retirement. I meet a lot of people who don't know what these are, and they're very, very simple. They don't have an annual fee. There is a surrender charge if you cash it out, but it comes with a rate that the company will guarantee for multiple years. That's where the name comes from, multi-year guaranteed annuity. So they'll say, okay, if you're willing to commit your money for 3 years, we'll give you 5.7%, no fees, every year for 3 years. You can take your interest off the top, just like you could at the bank with a CD. And then when the 3 years is up, you're going to get choices. You can either renew it for another multi-year guaranteed annuity. You can 1035 it to another type of annuity. You could just surrender it and take the cash. And you get the choice on what you want to do. And it's very simple, very straightforward. That's really all there is to it. Now, there are other types of multi-year guaranteed annuities that offer some kind of interesting features. So there's some companies that will let you customize your multi-year guarantee and say, hey, you know what? If you don't want your interest over those 3 years, we'll give you a little bit of a higher rate. Or if you're okay with surrender charges applying to a death benefit in case, God forbid, you die during the 3 years, then we can also give you a higher rate. So there's some ways that you can customize these to get a little bit more interest out of them if you know the type of withdrawals that you're going to want to take up front. Now, if you want the most flexibility, you're going to want to avoid those types of rider, what they call it, they're like riders. So you purchase these riders and it lowers the rate to give you more liquidity for certain events, like if you want to take penalty-free withdrawals during the 3 years. And again, I'm just using 3 years as an example. It could be a 5-year annuity, it could be a 10-year annuity. But the 3 year is really, really popular right now. The rates are incredible. So that's where I'm kind of focusing on, is that 3 year bucket is really, really kind of a sweet spot right now. And you'll see as interest rates change, you can see that at the bank too, when there's certain sweet spots with CDs or certain sweet spots with fixed annuities, and they kind of change and rotate. And that's one of the fun parts about being independent is, you get to look at all the companies and figure out, hey, who's got the most competitive rates in what years. So if you're building a ladder, like you want to put a portion of your money in a 1 year, a 2 year, a 3 year, a 4 year, and a 5 year, then what you can do is you can be strategic and say, okay, this company is a really great company. They got the best 1 year in terms of the highest rate. then this company's got the best 2-year in terms of the highest rate, and you can stack them. And what people will typically do is if they're going to do a annuity with, or a ladder with 5 annuities, let's say you have $100,000, you put $20,000 in each. Every year you're getting $20,000 of liquidity as an option if you need it. And then if you don't need it, you can buy another 5-year. And that's going to keep that ladder going so that the next year when the 2-year matures, you can get that choice. Do you want to take your money and have that liquidity, or you want to get that higher rate and keep it rolling? And then when you build that ladder, you're constantly getting new liquidity, and you're constantly getting the highest rate on the last dollar you're putting in, which is really exciting. So another awesome place people are using this, that they don't really understand, is they're getting ready for retirement. They're in their highest earning years, and they have a bunch of CDs at the bank or accounts at the bank, savings, high yield savings, money markets, things that are generating taxable interest when they're already in their highest tax earning bracket they're going to be. And in 3 more years, they're going to be in retirement, and it's totally going to change because you're going to be on Social Security. This is one specific example, but where this is really powerful is you can defer that interest with a multi-year guaranteed annuity. So you could say, hey, I don't want to incur this taxable interest, but I do want to keep the money safe at, where I can access it in a couple years, and then I want to be able to earn that interest. A multi-year guaranteed annuity will give you that tax deferral, so that way you can get into retirement, and then you can realize the gains on that interest and pull that out once you retire and your tax bracket changes. So again, that's not tax advice or anything. That's just like one way people use them a lot, because that tax deferral is really powerful for people. And so it's exciting. Another way people are using it is to hedge their fear of interest rates dropping. So if you're really concerned about the interest rates falling, maybe a 6-month, commitment isn't long enough, because when 6 months is up, then you got to find a new rate. And if the rates are lower, then you're going to be at a race to the bottom. So where fixed annuities and these multi-year guaranteed annuities really come in handy is you can ladder out 5, 10-year annuities. If you're happy with a 5 or 6% rate and you're like, hey, that's good, I just want to lock that in and get that interest and live off of that interest, that's a great way to do that and be able to secure a good amount of time with a portion of that money. Obviously, you wouldn't want to tie up a lot of things that you need to have liquid or long term, but if there's a portion where you're like, hey, I just really want this interest off the top and I want to make sure that rate's going to be there for me, that's really where it shines. So I hope this video clears that up. If you like videos like this or a little bit more in-depth and talking more about products, check out this video here where I break down the frameworks of where you can use life insurance. It's a very similar type of video. I hope you enjoy it.